Time for another market review, only this time I'm coming to you from this place, which I know is not a kitchen. And I know you're probably thinking, AK, how can you cook up your fire content without your sink and your stove right here? I really don't know. I mean, maybe I should get a George Foreman right here. Instead, what do I got? This phallic looking mic? This chair back here that just looks like it's staring at you? Or this fake tree, which, doesn't even reach the ground? It's all very sad. I don't know. It's like I'm doing the opposite of the Jeffersons, just moving on down. This place looks like the stock market without Powell, just a mess. Speaking of Powell, you're probably wondering why I even do these videos anymore, because it seems to be clear that the stock market only goes up day after day. Why even consider any other outcome? Just put your money in and you'll have more money tomorrow, right? Maybe, but let's look at the data. But of course, as always, before we get started, this free training is important. If you haven't taken it already, there's a link in this video and down below in the description and comments. It teaches you our entire strategy, the same one I use and a lot of our Fallible members use as well. Definitely check it out because yeah, it does really well in these types of markets that constantly go up, but who's not doing well? But more importantly, it saves you when the market tanks, which you might not remember, but that does happen. All right, let's get into it. And let's start with this quote from Samuel Smiles. It will generally be found that men who are constantly lamenting their ill luck are only reaping the consequences of their own neglect, mismanagement, and improvidence, or want of application. Meaning, a lot more is in your hands than you think. So stop complaining. Don't complain about the new room that you're in to record videos, just fix it. Thanks, Samuel. I feel like this is a direct shot at me. But on to the markets. So the two key pillars of this rally off the March 23rd lows have been incredibly bearish sentiment and extreme underpositioning and risk assets. But both of these have been chipped away as sentiment and positioning have chased prices higher. They are now no longer a tailwind to risk assets. And you can see here this blue line has spiked from the bottom. It is getting back into a normal range. And this is a sentiment index. And what do we know about sentiment? The more bearish it is, the better it is for the stock market, because that's more money on the sidelines to come in. It's that wall of worry that the market can keep climbing. But if everyone's bullish, that's when you got to look out below. That's when people get over leveraged, they start putting too much money in, and then what other money can go into the market? They're overextended, then you see the thing fall. So it's counterintuitive in that way. So the fact that sentiment is recovering and people are feeling better is not necessarily bullish for the stock market. We need some volatility to shake things up. Now, over the last few weeks, we've seen some rotation into small cap value versus growth and momentum. So this graph down here shows the pattern that this usually follows. Small caps, this black line, usually follows the blue line, which are the large caps. Large caps just trend ahead. So if this works out, then small caps should soon start to materially outperform. But looking at it another way, there's a good chance that that outperformance will come from falling less versus rising more. You can see here, if we see this, then small caps will just be safer assets to stay in. And both of these charts, this one and the one before, are both market action after steep drops in sentiment, which is exactly what we saw here, right? This huge steep drop, but now it's recovering. And this is going all the way back to 2002. Now the SPX has obviously had a few very strong months, but right now it's in the weakest 2-month seasonal period of the year. So if you take a look at this heat map, you can see with a 30-year average, historically, June is not a good month, and neither are August and September. Our August has been pretty good. We'll have to see what happens in September. And obviously our January through March were horrible. So we might not see that seasonality here in September. Now in the hierarchy of markets, which is basically which markets you can follow that are leading indicators for everything, meaning between equities, bonds, metals, commodities, those types of things, credit traders sit near the top, right below metals traders. Basically in this hierarchy, all we say is that certain traders, depending on what market they're trading, they're going to know information way before everyone else. Because if something happens in the metals market, say something bearish, then you know it's going to trickle down into every other market. That's why we call it the hierarchy. So for example, in metals, if things are bearish, metal prices are coming down, what does that mean? Less construction going on globally, which is an indicator of the economy, which will eventually hit equities, right? So here we're talking about credit traders who sit right underneath those metal traders. They're second on the list, which is why credit leads equities, because credit kind of shows you the risk appetite in the market. So we should be concerned right now about the widening credit spreads. So if you see right here, this red line is the credit line. It's turning lower, meaning it's no longer confirming this higher move in stocks. You can see how they kind of move together, with credit being that leading indicator. Now we're not calling for a top here because the probability is that the market is going to keep running higher. But if this doesn't fix itself, meaning the red line and the rest of the market move together, then we might see a drop. So this red line needs to recover, the credit line. Meanwhile, the median PE has doubled since the March low, and now it's at record highs. That shot up real quick. You can see that right here, it's at 22 now. And positioning the NASDAQ, which is this blue line here, is extremely elevated according to UBS, which isn't really surprising given that you could just invest in a FANG stock and it's gonna keep going up. That's what I was talking about earlier. Seems too easy, and that's what everybody has been doing, getting into the few tech stocks leading the market, and that's why there's over positioning now. Now the macro backdrop to all of this is a White House and a Congress in recess till early September, after failing to make any progress on fiscal talks. And that's bad news, especially considering the fact that banks have essentially stopped lending. So here's a passage from Morgan Stanley discussing the latest Fed SLO survey. And SLO is the Senior Loan Office, and that survey indicates that banks reported much tighter lending standards across all loan categories. And that acceleration in tightening is faster than anything seen during the global financial crisis. Demand was also weaker in all categories except the residential mortgage, with commercial and industrial loan demand falling sharply as companies pay down credit lines. Banks tightened standard across all loan categories at an accelerating pace. So you can see right here, this huge spike is net tightening happening, while at the same time we're getting weaker demand. And what do we know about liquidity? We want to have money flush in the economy so everyone can borrow and everyone can pile it into the stock market. But at least for the companies that are getting loans from these banks, they needed to keep going with business. Because yeah, tech companies are doing great, but what about everyone else? There's still much lower economic activity. So it seems like, yeah, Powell is able to come in and stimulate everything and everything is okay. But now when you look at this data, it looks like it's very fragile. So as soon as the money slows down a little bit, things start falling apart, especially considering this was the fastest tightening that's happened. Way faster than anything seen in the financial crisis. Kind of crazy. Another topic we hear about constantly now is the end of the dollar because of all this printing. And if this US dollar bull market is over, it would be the shortest one ever. A bullish development for the euro, which is bearish for the USD, is the recent creation of a European supranational fiscal program. So Credit Suisse points out that there's plenty of room for the euro to increase its role as a reserve currency. Considering that the USD is going to die, or everyone thinks it is, who's going to take its place? Euro is looking better. You can see right here, euro as a percentage of allocated FX reserves is much lower than the USD. So lots of room for people to switch over from the dollar. And here's a chart from Morgan Stanley showing the monetization levels, or the ARPU. And ARPU is the average revenue per user of every big tech platform. And it looks like YouTube is by far the most monetized digital asset out there. Facebook being number one by a huge margin. TikTok being the lowest. They haven't figured that out yet, but YouTube is surprising. So it looks like Google isn't monetizing you guys properly, all of you watching this video. Which, funny enough, for these videos, if you make them over 10 minutes, which is why you see every YouTube video over 10 minutes, you get double ads. So that means more revenue for Google and more revenue for the creator. But starting in October or November, I don't remember, they're actually reducing that mark from 10 minutes down to 8 minutes. So what you're probably gonna see is a lot more 8-minute videos because no one has to stretch to 10 anymore. And those 8-minute videos will get the double ads, which is just another way that Google is trying to monetize. Bring up this ARPU of $9 to something a little better. That's interesting though that Facebook is so much higher. They really got monetization down. And lastly, there's a lot to like about natural gas and natural gas stocks right now. The capital cycle is supportive of a cyclical bottom and sentiment is as bad as it can get. And the curve is at levels that tend to coincide with bottoms. So if you're looking at any natural gas companies, this is the time to look a little harder. But if you want a very easy strategy that's easy to execute yet very effective, then remember just to check out this training. There's a link in this video and down below in the description and comments. It's free, definitely watch it. And it actually simplifies a lot of the analysis that we're doing here. It codes it all up so you have an algorithm that takes all of this into account so you don't gotta worry about it. Definitely check out that training. And one more thing I wanted to talk about in this video is actually the last video we did on Bill Gates. I was shocked to see almost every single comment calling Bill Gates a murderer, saying he's trying to depopulate the world with vaccines. I thought maybe a few people thought this, but in the comment section, it was like everybody. No one believed in science. It was wild. And I just don't understand why people hate Bill Gates so much when he literally dedicates all his time to helping people. But for some reason, everyone thinks instead of helping people, he's actually trying to kill them in some sinister plan, which is why I now understand why he sounded so annoyed in that interview with the conspiracy theories. So the big one that I learned about through these comments that I didn't even know about was Bill trying to depopulate the world. Billy G, that's who we're talking about. The reasoning for this theory is that there was an interview where Bill Gates did say the world is overpopulated and vaccines should fix that. So I don't know if this was taken out of context or what. So people immediately thought, okay, vaccines are meant to kill people. That's why Bill Gates is doing all this. But really what he was saying, and he said it multiple times and explained it very clearly, is that the reason families in developing nations have so many kids is because they're not sure all those kids will survive. There's a much higher mortality rate for those kids in the developing countries. So they pop out like 8 of them just in case 4 of them pass away or something, because they don't know. But if you introduce vaccines, then those kids are much more likely to survive into adulthood, meaning that people won't have to have those 8 kids. You don't have to play the numbers, which is crazy to think about because they're kids, but that's how bad it is over there. So Billy G explained that even though it's counterintuitive, saving more lives will reduce the population because of that fact that you don't have to have so many kids. It'll be more like in the Western world where you could have 2 kids and be okay. In fact, no one really wants more than 2 kids. So I don't really get why that got twisted so hard. And then of course the microchip thing, like Billy G is trying to implant microchips into you. Do you not remember that he's the guy who started Microsoft? Most of the things that everybody is using has those chips in them. So if you wanted to do that, it's already done. He doesn't need vaccines to do it. And the stupidest comments I saw were people saying, AK, you're drinking the Kool-Aid. You need to think for yourself. And thinking for yourself, yeah, I agree about that. But for a lot of this stuff, especially with this pandemic and things that Bill Gates is doing, how exactly are you thinking for yourself? Are you collecting your own data on mortality rates? At a certain point, we're all getting secondhand data, which makes it very tough because that data can be manipulated. So even in this whole CCPV thing, we don't even know how many deaths are actually happening because every state is recording them differently. I see these Twitter threads all the time explaining, oh, this is not right, this is how you do it. So it's all interpreted differently. And I understand the distrust in the government and maybe in these billionaires too, but I don't know, you can't convince me that you found some website on the internet and that's the real data. Oh, I did the calculations for numbers I found on Wikipedia. Do you think what you're doing is any better than what the experts are doing? Where's all this data even coming from? I don't know. I agree in general, think for yourself, but also there's many scenarios where you don't have all the information and you don't even know if it's the right information. It's like when these Chinese companies publish their quarterly reports. Yeah, let me look at that data and think for myself, but in reality, all that data is skewed. A lot of it is fabricated and made up just to look good. That's why I actually think they should delist all those Chinese companies. Anyways, I was surprised by the comments on that video, but it is what it is. Maybe it's a sign of the times. And maybe everyone is right and I'm completely wrong. That's why I stay fallible. But as of right now, none of that stuff made sense to me. All the conspiracies. Anyway, check out the training. Link here and down below in the description and comments. And if you like this video, make sure you subscribe. That way I could do another market review and another video about Bill Gates so everyone can comment with crazy stuff once again. Or maybe it's not so crazy and I'm the crazy one. Who knows? Find out in the next episode. Maybe this tree will grow. Probably not, because it's fake. Anyway, subscribe and I'll see you in the next video. Stay fallible out there. Bye.